topic today is actually a fascinating one. We've been watching the US market have some fun with single stock ETFs of late, including some inverse and leverage product. And much to our delight, right before the holidays, another first hit Canadian markets with the rollout of Purpose Yield Shares. As usual, we're not about to leave you to your own devices to figure out what these new products are. So we thought we'd bring in the experts, take your questions, and address a few along the way in the form of an ES Spotlight today. I'm thrilled to be joined by Nick Mersch, Portfolio Manager at Purpose Investments. Nick, welcome to the show.
Thanks so much for having me on.
Absolute pleasure. Then for our audience today, if you're new to our spotlights, quick housekeeping. We've got you for 29 minutes. Ask your questions in the chat box. We'll answer them, work them into the discussion, or we will follow up with you after. If you're also new, don't forget to follow us on social. You can keep up on updates, and we'll be posting the recording online afterwards if you're unable to stay with us for the full time. So, Nick, to the main event. I think most Canadians know all about Purpose Investments. And if they don't, I'm sure many investors are going to be seeing you, as have I, on the back of every airplane seat for the next year as we reemerge more homes. Tell us a bit about the idea or the spark behind Purpose Yield Shares in particular. Who puts this thought or idea into your brain?
Yeah, for sure. So I think during a lot of the Air Canada ads, there is what we were known for a while, and it used to be you couldn't skip it, but and now you can. So hopefully we can catch your attention enough that you'll actually watch through the whole advertisement there as people kind of get back to traveling, hopefully. But yeah, I think, and thanks so much for really taking the time to learn about this product. But the concept of Purpose Yield Shares is really just to collect rent as you house your favorite securities. And this product really does aim to mimic the return of the long-term return of the underlying security while generating some monthly yield in your portfolio. And what we saw when we looked at the marketplace was really a product gap. So as you had mentioned, on one side, you kind of had these synthetic equity products that were 3x leverage. You didn't own the underlying. And there were these complicated structures that I think were really detrimental to sort of investors with longer holding periods and didn't really understand some of the decay on them. And then on the other side, what you had was some of these covered call strategies that just gave up too much upside when you do get one of those bull market runs. So with this product, as we'll walk through, we do use a combination of partial call underwriting strategy and combined with a moderate portion of leverage, which gives us a really nice blend in terms of total return, while also maximizing that monthly yield on the holding.
I love it. So the innovation is really a single stock exposure with rent, the yield ultimately. And you can see the list of tickers behind me if you haven't found them in your own discount or financial terminals yet. But 5 of them out in market today, hopefully some more to come. Let's kind of drill into this from the perspective of a do-it-yourself investor, and then we'll follow on with the financial advisor perspective. So I'm an end investor. I have access to the underlying stock. I can buy it directly on US markets. Why would I want to be looking at yield shares in single stock ETF format?
Yeah, for sure. So what this does is add that component of yield by selling options, the call writing strategy that underlies it. So I'll break it down into 3 components of what the yield shares are composed of. So first, the yield shares purchase outright the common shares of the underlying and own it directly, versus some other products that might own it through synthetic positions that are a side way of owning the stocks directly. The second component is that we use a covered call strategy by writing options targeting around 50% of NAV. Is the third, then we then add a leverage component around 25% of NAV to purchase additional common shares of the underlying. And this more closely links the return of this product with the performance of the underlying while generating that monthly yield. The product also has 3 additional factors that make it really a one-stop shop for any investors trying to pick up yield. So the first is that it's CAD hedged with futures. The second, that it's very tax efficient because the yield here is distributed as capital gains rather than income distribution because of the position is considered a hedge instead of a speculative position. And the third is that since it has an ETF sort of Canadian unit wrapper around it, this categorizes it as a Canadian holding rather than a US holding. So we believe that using this strategy and really combining all these features into one easy to use product, so you don't have to constantly monitor your options positions. We do all that in-house. And you don't have to hedge your currency positions. We do that all within this product. It really combines a lot of these unique features into one easy to use product to again maximize that monthly yield while having that return exposure to the underlying.
I like it. So there's actually a lot going on under the hood for ultimately a single click from a retail and investor's perspective,
That's
especially
right.
for those perhaps who don't have access to the options market, or putting on a hedge on a single stock basis really unachievable for retail. Take it a step further. We've got financial advisors who have access to a lot more tools and capabilities, especially as your book and your portfolio grows. Maybe you're running some models where this might be useful. What do you think is the value add from an advisor perspective of looking at this type of product?
Yeah, and again, what this product really does is it puts you into the driver's seat. So what we view this as a tool that all investors and advisors can use in order to really change the characteristics of your portfolio to generate yield. So instead of having to balance all these different positions and all these different exposures, it is wrapped into that one easy to use product. But at the same time, what we're trying to do here with this product is maximize the probability of positive outcomes versus just owning the underlying. And especially if advisors want to take active approaches around the edges, which is some of our calls have really been diving into that, is people are saying, looking out into the next year and saying, hey, look, there's one thing is for certain, and wherever we're going, it's going to be a bumpy ride. So with advisors that want to get a little bit more opportunistic and add some of that alpha around the edges when it comes to volatility, that's where we really excel in terms of our options writing strategy in order to pick up that yield.
I love it. Third time's the charm. So let's maybe dig into a little bit some of those individual components. You mentioned at the onset a bit about the allocations and how you're breaking up kind of the exposure to the underlying, the little bit of leverage you drop in. Is it the same ratio and proportion inside every yield share? So if I buy the Apple yield share versus the Amazon yield share, I'm getting the same allocation, same strategy, just with a different underlying stock?
Yes, that's right. So the approach that we've taken, we've copied and pasted that into these each individual securities, and the 5 that we've launched already and 5 to be launched over the next coming months here. So again, we directly own that underlying, that moderate leverage of 25% and then the 50% covered call. And the way that it works is if we're called away in the event of a bull market run, we then repurchase that security on the same day in order to maintain that ratio. And we also CAD hedge it back on the same day and adjust our options and leverage components accordingly. So this systematic approach really allows us to properly manage inflows and outflows as well, extremely well, and really keep our ratios leveled to our target allocations on all the different components of it. We also operate around a band, because what you have to optimize behind this is a lot of the trading costs, and we're doing that actively. So that's why we have that target range of the 25% leverage and the 50% covered call, but we do operate around a band in order to not overtrade. And we're really conscious of that. And we've built out extensive back-end expertise to really optimize all the costs.
Supreme. And actually, that's a very important point to highlight. Some minor fluctuations along the way to keep it efficient for your investors. One other comment, which you hit on at the beginning, but I really want to bring it home because Canadians, we love our dividends at the end of it. A number of the single stock ETFs that you've launched, some don't pay dividends in them, so it's probably not a problem. Others perhaps do. The dividends, I think you mentioned earlier, wrapping those into the portfolio itself and paying out the yield as a capital gain instead of dividend. Is that my understanding?
Yeah, that's correct. So I think this is an important question, because the whole premise of yield shares is to add much more of a component of yield to these names. And if you think just typically these underlying securities, the dividend yield that these stocks have provided has been minimal, if it exists at all. So your example there, Apple, their dividend right now is 0.6%. So 60 basis points is their dividend, whereas our product targets 9% for the yield. Amazon, Berkshire, Google, and Tesla all don't have a dividend. So we're offering target yields of 6% for Berkshire, 11% for Google, 10% for Amazon, and 16% for Tesla. So this is an excellent way to introduce more yield into the strategy. When it comes to the actual sort of mechanics of paying out those dividends, when it comes to Apple, so we would capture around 75% of that dividend that it does already pay out because we're long the underlying 100%. But we do use leverage component of 25%. So that net component is about 75% capture of the dividend that we're having there. There's also nuances around the moneyness of the options around certain dividend dates. But these are all things that we're actively monitoring in order to maximize yield. I do think it's important here to kind of just tack on and get into a little bit of the option strategy. So our proprietary option strategy, we write 50% of the exposure between at the money and 5% out of the money calls with an average maturity of around 30 days. And at any given time, we have somewhere between 10 to 12 legs of options written on each security. And this allows us to more optimally farm a lot of this yield while mitigating the path dependency when it comes into the price action of the underlying. Because if you only have, say, one options position, you're very dependent around that expiry date in terms of how the stock has moved. So by laddering a lot of the maturities, what we've done is really get rid of that path dependency. And as we saw in sort of the volatility in the market that we're seeing lately, but also in the CPI print this morning, I mean, it's been an absolute roller coaster. So you really want to mitigate some of that risk when it comes to the path dependency of these stocks, so you don't get called away too frequently on the upside.
Now, the thing that I'm hearing is a lot of thought, attention, strategy, and planning into ultimately how to bring this product out to market. And as easy as it is for us to point, click, and buy, a lot of heavy lifting behind the scenes to kind of mitigate actions or reactions, both in market and as a result of flows and usage of the product overall in different asset classes, which actually takes the experience and expertise of a bona fide asset manager to deliver on properly. So it's good to hear those things coming out. And if all of you in the crowd perhaps haven't wrapped your head around options, by all means, also, this is where the conversation with purpose can be a benefit for you and understanding the product and getting a bit of a feel for how yield shares will operate. So let's take a bit of a step back then. You mentioned you've got 5 out of market, a few more to come, I'm sure. What's that conversation with advisors looking like as we're starting to see daily trading on all the mandates now? How's the audience kind of responding to the product? What are your conversations looking like?
Yeah, for sure. So a lot of the early discussions that we're having for advisors is one of scaling in. So we're seeing a lot of advisors say, okay, I've seen how this traded. It's been out for a couple of months, and there's actually a lot of positive reception in terms of the upside that we are capturing in the year to date, given this run that we've had. It's coming to prove the most people wrong, is what the stock market's usually the best at. But a lot of advisors are saying, okay, I have this direct exposure where I hold the underlying directly of these names, but let me scale into it to see what it looks like. So we'll start with 10% of the direct exposure into this product, then scale into 30 to 50% and gradually increase this just as they see how it performs, and also have a blend of that risk exposure to the upside while capturing that yield component. But the way that we've constructed these is that we've really captured enough upside in the strategy that we have that eventually the position can easily become 100% of each position in the advisor's book. And it's a really great sort of pure play way to own exposure to that underlying while generating that yield.
Interesting. So it's a good conversations to date. Advisors get the ETF framework. Some of the larger books obviously more attuned to the effort it takes to bring that options overlay and covered call strategy into play, and starting to see some good conversations, I presume then.
Yeah, that's right.
Superb. Maybe elaborate a little bit. So you've got 5 out in market now, and if I know the purpose team well, anything worth doing is worth overdoing. If I'm not infringing on somebody's patent rights on that tagline, but at the end of it, you mentioned you've got more coming. We've got mostly tech names and Berkshire kind of attached. Where are you headed next on product? If you're able to say what's kind of in your focus area.
Yeah, so we've launched on 5 names: Apple, Amazon, Tesla, Berkshire, and Google, as you can see in the background wheel there.
Where's the Tesla
also,
one? It's in the bottom.
yeah, exactly. All very tech dominated, right? And we started with these because they've had excellent deep options market where we could be very advantageous in terms of our call writing strategy. And the next 5 names have the same deep liquid markets, but they're expanding a lot beyond just tech. So coming up in the next month, we'll have United Health, Exxon, JP Morgan, J&J, Johnson & Johnson, and then also Microsoft. And this is all as we expand the product line to meet the needs and appetite for those looking for different components and different pockets of the market where they think they can better pick up yield. And I think in terms of just kind of the component of how a lot of these tech stocks really had this massive sell-off last year, We do advise getting independent tax advice, but in terms of our studies so far and our conversations with third-party tax experts, this product does form as a switch if you want to lock in some tax loss selling in terms of switching from that tech position that may have been down last year into one of these. And you don't have to have that 30-day holding period. As you can see, we can have these massive rallies. You can still have that exposure to the underlying and still participate into that upside while switching products and locking in those capital gains tax losses. So we're seeing a lot of that in terms of that initial product launch around that specific industry. But as the popularity for this increases, and as we've already built out the back-end expertise, we can scale out in terms of the different products we're offering. And always glad to have conversations with advisors in terms of where they think the next appetite is. I think I'm just going to kind of jump over quickly to, there was a question asked in the chat here just live. So it says, will you consider using a strategy on a broader index like SPY, which is right in line with the product offering that we have to date. So as of right now, we're not doing it against an index specifically. But that is something we're exploring with our team in terms of the internal discussions, and we're engaging a lot of interest for that. And more advisors have been coming back saying like, hey, look, I love the strategy in terms of capturing a lot of that upside and while still generating yield. Can we do it on a broader based index? And this is something we're exploring and we're in the conversations having. So love the feedback on that and would love to kind of hear more about that afterwards, but I'll turn it back to you there.
Super. Thank you. I actually missed having the Q&A box open. I had the chat box open instead. So I'm glad you were paying attention. Actually, there is another question in the question box, but I think we had planned to chat about it anyway. So we'll weave the two together with market conditions. And you know, you read the headlines today, you kind of get ups, downs, mood swings, so to speak, in market. Choppy seems to be the general macro theme that we're going to see for the next quarter or two in markets. Let's maybe chat through a few different scenarios. We'll use maybe the Tesla yield share as an example, since that's had the most movement in the last week or so. Let's say the underlying stock goes up in market. How does my Tesla yield share holding actually behave?
Yeah, absolutely. And I think this is definitely pertinent in terms of just our current market conditions, and the absolute sort of best relative performance for yield shares is going to be those highly volatile sideways markets, because that's where we pick up the most yield in terms of the relative performance versus just owning the underlying. But this is important to look at in terms of the context of just Tesla, because it's sort of everyone's retail favorite. We know it's super volatile. We know it can go on those massive bull runs, but can also go on those massive bear runs. And I think this is important because that year to date, we're having that market rip as the stock market really does, continues to prove the most people wrong again. And other covered call strategies would have drastically underperformed in a lot of these scenarios and completely missed the rally. Whereas what this product does is, because it has that leverage component and it's not fully underwritten, we capture a lot of that upside. So for example, over the last 1 month period, if you look at Tesla, it's up around 67%, depending on how much more it yo-yos today. And our yield share product has captured a majority of that upside. So it's up 61% over the last month. So if you think about just that percentage of upside capture that we still have in these volatile periods while picking up that yield, you can see how this starts to make a lot more sense. And in terms of when it performs, we'll say it goes on to the downside into a bear market. When you do have one of these, because the product does have that leverage component and it's not fully underwritten, we're not picking up as much yield if it was 100% underwritten. And we do have that leverage component. So it does have the effect of also going down to the downside in a similar manner. But in a highly volatile stock like Tesla, what typically happens in terms of our back testing through our models that we found is that the yield generation component outweighed the component of leverage that really had the stock down move. So what we found was in the more volatile names, there was great cushion on the downside in these bear periods as well. But I do want to reflect the point that it mimics the return to both the upside and downside. And while the downside might have a little bit cushion, we do still have downside exposure.
Supreme. And I'll ask the silly question in case the audience doesn't beat me to it. You still get the yield no matter which direction the underlying stock moves. That's the whole point of the product, right? That's right.
That's right. You always get the yield no matter what. The leverage component always works in the direction of the market. And then you'll always have a opportunity cost component from the call strategy if you do get called away to the upside. So those are the three components of return that differ the product from the underlying itself.
Supreme. I got an interesting one in the chat box around liquidity, and I know
Mhm.
Purpose, obviously a large ETF shelf, and we spend a lot of time together and individually chatting about liquidity in ETFs versus liquidity of underlying and how to represent that on screen. But the question directly from an audience member, I assume liquidity issues are not material due to liquidity of underlying shares. The volumes on yield shares are rather anemic, was the question mark, but maybe over to you for the usual ETF spiel on liquidity.
Yeah, absolutely. So I think you've hit the kind of nail on the head there in terms of the first part of that question, in terms of assuming the liquidity issues are not material because of the underlying shares. And that's also to speak in terms of how deep the options market is as well. And that's very important from a liquidity issue. So the liquidity issue of the shares themselves is not an issue at all, because they are the highly traded, the larger market cap names. But it's also really important to pay attention to that options market liquidity too, because that's an important factor. Because if the options market isn't super deep and liquid, we can't execute our strategy as well, which is why we pick these names, because we understand these options market, we know how they work, and we can really efficiently farm that yield component. When it comes to the liquidity on the shares themselves, that's not an issue. We have all these relationships with the market makers themselves, and as this product increases in popularity and starts to really take off here, we're going to see that liquidity pick up. But that really isn't too much of a factor, because we can keep those spreads super tight. Reach out to us or someone directly here if you want to do one of those bigger trades and talk about how we can get that spread tighter, because we're always willing to make it sort of work from a cost perspective, because we want the best solution through this ETF structure that you have liquidity. And we can also work with you directly to get that spread tighter, to make sure all the costs are optimized to the highest degree there. So I think that's an excellent question.
I love it. And I think you just knocked out like 4 of the stereotypical ETF myths all in one answer. And it's a critical one too. New funds, it takes time to build up and grow that secondary market following, where you get good two-way liquidity. But in the beginning, it's all about getting early adopters, and liquidity risk, pretty much a non-event for the group of securities you've cherry-picked to lead with. At the end of it, for us, the biggest thing is about know how big your order is and manage your order accordingly. If you're going to outsize the bid or the offer, hopefully it's just offers to begin with when you're buying into the product. Reach out, be smart, or use limit orders specifically to trade at your position and bring others into the portfolio. But Nick and the Purpose team love chatting as much as I do. So feel free, reach out, ping in, and I'm sure we'll be able to find folks to help you along.
Absolutely.
Looking into a few of the other Q&As that always come up with new product launches. These are ETFs ultimately wrapped with some underlying technology, but these are suitable for registered accounts, TFSAs, non-registered accounts if people want to use them. Any particular strategy, especially at this time of year, given we're in classical Canadian RSP contribution season, that you've been hearing folks talk about? Thought I'd give you a few moments to chat about ideas.
Yeah, so these are suitable for all the above, and the beauty of this product is really just the nature of that yield component being taxed as a capital gains instead of an income tax. So what you have there is a lot of flexibility when it comes to what kind of structure you want to put that in. I know a lot of people just use those different kind of structures to have maybe there's more yield generating product in those registered accounts, because those are protected in that system. So however you want to plan in terms of balancing that mix of the income generating portion of your portfolio and where you place that in the registered and non-registered accounts, the component of it being capital gains instead of income tax really allows you for a lot of flexibility if you want to go for that capital appreciation, or if you want to go for that income component in certain different registered and non-registered accounts. So that flexibility of it really puts you in the driver's seat when it comes to which account you think it's best optimized in.
I love it. And another added benefit, I think, you start thinking about Canadians. We all make money in Canadian dollars. Being able to buy these stocks and ETFs ultimately in Canadian dollars, get the option strategy all baked in. You also mentioned a CAD hedge wrapped in there as well. Like, there's a lot of things that are really custom built to support the Canadian investor getting access to some very unique strategy that, frankly, as retail customers, be really hard to find somebody to do for you on a standalone basis.
Yeah, that's exactly right.
I love it. My favorite question for you, and the purpose journey with us here at the Neo Exchange goes all the way back to the very beginning, where you were one of our first issuers to list on Neo and Purpose Yield Shares. A very happy welcome back to you and the crew to our exchange. Selfishly, perhaps a bit of color on the decision, as inevitably, I'm sure a lot of investors poking around and realizing, there are multiple marketplaces in Canada where you can list your product.
Yeah, for sure. And not to sound sort of empty promotional on a softball question, but the genuine answer here is that we've found that working with Neo on a lot of these disruptive products on a disruptive exchange really does make a difference. So it's a perfect place to really go out and generate a lot of these differentiated ideas. And you really do need someone on the partner side that has the same sort of mindset, all the way just from management to principals, and really just getting out there and really pushing the envelope in terms of innovation. So we think that Neo in this regard is the perfect partner, because you have to be a little bit unusual to have unusual returns. So I think that front of it is always extremely attractive for us, and why we've really leaned into the partnership.
Yeah, I love it. Your tagline actually quite fitting some of the other stuff that we like to spend our time on. I think that the tagline of "We do difficult" tends to be an area of interest for myself, certainly for the team, and some of these new innovations. Just incredible to watch the pace at which asset managers and dealers are ultimately transforming and changing the way Canadian investors can get access to some really unique product, especially in this market. So very proud to welcome you back, and thank you very much for the kind words. Time flies, which may be no surprise for you, but I feel like we could do this all afternoon if folks would let us. Parting words, Nick, on your end, if there was one thing that you wanted our investors to take away from the discussion today, what would it be?
Yeah, and I think the kind of tagline here is pertinent to the Canadian market, because we all love the housing market. But the takeaway here, I think, is it's time to earn rent on housing your favorite securities. And Purpose Yield Share really does provide exposure to that long-term performance of the underlying asset, while maximizing that monthly yield. And we do this through our proprietary option strategy, in which we can effectively farm that yield while having exposure to the upside in some of these bull runaways. So we do believe that this product has a place in every investor's portfolio, whether it's scaling in at the beginning or going all the way to 100% in terms of the product for that exposure to that stock. So really excited with where it started now, and excited to see where it'll grow and just how we're going to build out this platform.
Yeah, I love it. And I think that line's the right one. Rent out your underlying stocks and get some yield on it. It should fit well with the classical Canadian investor. Nick, it's been an absolute pleasure having you digitally today, and confident. Obviously, our audience got a lot out of the presentation. We covered a lot of ground today. Really appreciate you taking the time out to share your insights, and of course, grateful for your support in evolving how Canadians round out their portfolios with Purpose Yield Shares. Truly another incredible innovation, and no surprise coming from you and the Purpose crew. That said, looking forward to welcoming you and Purpose back to Neo for another launch soon when you guys are ready. To our audience, certainly thank you for joining us. We got to most of your questions today. If you think about any afterwards as you're watching the yield shares turnover in market, reach out. This video will be posted, and like it, subscribe, share, make sure you keep current with all the updates from both Purpose and from the Neo Exchange after today's presentation. Happy Tuesday to you all. Happy Valentine's Day. Also, this is the Neo Exchange and Purpose Investments signing off. Nick, thank you so much.
Thanks so much. Appreciate the time.